you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset.
There is a possibility on the other side of this that inflation could actually be quite low.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers, and the data is in. And what we know right now, you guys, is interest rates, at least what we're hearing, right? Interest rates have completely plummeted, right? And now, as a result of mortgage rates plummeting, demand to buy homes is going to flood back into the market. It's going to jack prices up, and all of us should give up and just buy a house right now and be happy, regardless of whether or not we could even afford it. Isn't that the narrative that we're getting right now? Isn't that what the bulls are saying? The investors are saying? Aren't they saying that we're stupid right now for renting? We're stupid for caring about things like price? All we should be paying attention to is payment, and all we should be paying attention to is the narrative saying that there's just not enough homes to go around. We need, what, 5 million houses? Isn't that what they're saying? You guys, all of that is complete nonsense. And what we're seeing right now is we're starting to see the cracks once again in the housing market. Now, if you're wondering, why did we see such a rebound in 2023? Understand this: there would have been absolutely no rebound in the housing market like we saw in 2023 without the March 2023 federal bank bailout that injected $400 billion back into the economy. Now, understand that the bulls back then were just saying everything's about seasonality. The bulls back then mentioned nothing, you guys, absolutely nothing about the bank bailout. They just stayed safe and, oh, it's just seasonality. But now almost all of the bullish narrative has now circled back to the government's just going to bail us out. If you want to upset a bull, all you got to do is say the word fundamentals, because they don't exist. Now let's take a look at the 10-year treasury. You guys should know by now, if you've been watching my channel, the 30-year mortgage rates tracks the 10-year treasury. So when the 10-year treasury goes up, so do mortgage rates. When the 10-year treasury goes down, so do mortgage rates. So right now you can see that, yeah, the 10-year has gone down. We actually got basically 5%. So we came close to 5%. We hit 4.99% back on October 19th of 2023. So it has fallen about 100 basis points. So the 10-year for sure has plummeted, you guys. It has plummeted over the last 2 months. However, when we look at the 1-year view of the 10-year, it's still elevated. I mean, look at all of last year. It was well under 4%. Y'all see that? Look at, and now right now, again, it's at 4%. And what's also interesting to point out, yes, it did go down, but look at the trajectory. It is starting to go back up, probably because we need to continue to curve buying demand, specifically in the housing market, obviously, right? Now you can see the fluctuation of 30-year fixed rate mortgages. So this is the 30-year fixed rate mortgages. This is going back 1 year exactly. So again, look, it did plummet. I mean, we hit over 8% about the same time on October 19th. You can see it matches up perfectly with the 10-year. And then look at this, guys, plummeted down, right? I mean, oh my gosh, the buyers are coming back, right? Buyers are coming back. You know what's interesting is even though the interest rate plummeted, house prices for existing homes on average, they stayed balanced, and house prices for new homes continue to go down. Even again, with this massive, right? This is what we hear, massive decline in interest rates. So if we play on the narrative of the bulls, then this stands to reason that everyone's going to come flooding back, right? And going to buy these overpriced houses. How they're going to afford it, I do not know that. Why they would want to buy, I also do not know that. I mean, think about it. Why would you want to pay 50% more than what you're paying for rent and bring $70,000, $80,000 to close to the table? Why would you want to do that? Especially when we consider we can use our down payment to make money. We get paid to wait right now. We get paid 5% to wait right now. So if home values, I mean, think about it, you guys. There should be absolutely no rush to buy houses, but the real indicator here is, well, did mortgage purchase applications go up or down? Because remember, over the last couple months, interest rates dropped significantly, right? So let's see what happened to mortgage purchase applications. Now I'm going to do that by reading the CNBC article titled "Mortgage Demand Down 9.4% for Final Week of 2023 Despite Recent Drop in Interest Rates." Again, mortgage applications did not go up. They went down 9.4%, and that's year over year. So that takes into account seasonality because it compares it to what was going on last year. It's down 9.4% in the midst of massively declining interest rates. And they've stopped declining, by the way, but there was that sharp decline. Let's go on. The average rate on a 30-year fix ended the year at 6.76%, lower than where it was 2 weeks ago, but higher than what it was a week ago. Applications to refinance a home loan ended the year 15% higher than the same time period last year. So think about this, okay? And here's what I'm going to do a separate video on this, but refinances went up. And it went up right before Christmas, and then after Christmas came, it went dead, which to me shows the 3 weeks prior to Christmas, people were doing cash out refinances to buy Christmas presents. You guys, your house is not an ATM machine. That's how people get into trouble. Application for a mortgage to purchase a home ended the year 12% lower. So I apologize, guys. It's actually purchase applications are 12% lower year over year, despite, oh my God, interest rates are falling. People are going to flood back into the market. Well, it's 12% lower than it was year over year. Mortgage demand ended 2023 on a sour note, despite a sharp drop in mortgage interest rates during December. And that's because people are starting to wake up. Who cares about buying these overpriced houses? People are going to stop caring completely, and prices will come down. And not only that, even if they wanted to buy, even if they still, and there is a lot of interest still, they can't. Something like 90% of Americans right now can't even afford to buy a house. So the only people that were even buying a house right now were the people that were extremely well qualified. They took that extremely well qualified position that they were in, and they literally threw it out the window and said, I don't care about price. I will settle because guess what? I own a house. Now I can start living the American dream, right? Who cares that the mortgage payment's $4,000 a month, right? Wrong. We see that right now in these buyer's remorse surveys that have a ridiculous amount of buyer's regret reported on them. Total application, this includes purchases and refinance. The volume was down 9.4% from the week ending December 29th compared with 2 weeks earlier, according to a Mortgage Bankers Association seasonally adjusted index. The MBA was closed last week, and the results include adjustments for the holidays. The average 30-year fixed rate mortgage was 6.76%, lower than what it was 2 weeks ago, but higher than a week ago. That, however, is still well below the 8% high seen in mid-October. So again, we're well below, right? Well below. Where's the demand at? Where's the buyers at? Markets continue to digest the impact of slowing inflation and potential rate cuts from the Federal Reserve, helping mortgage rates to stay at levels close to the lowest seen since mid-2023. That's it, mid-2023. The recent decline in rates has given the housing market some cause for optimism going into 2024, but purchase applications have not yet picked up in response. Applications to refinance a home loan ended the year 15% higher. It's 15% higher. People are doing cash out refinances. Does that mean that they're in good shape? No. That means that they need money for some reason. And honestly, I think it's because, again, and this really sucks, you guys. It really sucks to say this. I think that there's a number of people that did that refinance, again, for Christmas. That's just so sad. And you see applications for purchase went down 12%. Let's keep going here. Those who can benefit from a refinance are trying to get in while they can. What does that mean? But the vast majority of homeowners today have rates in the 4 and even 3% rates. So why would they want to refinance into a much higher rate unless they need to, unless they have to, unless they need the money? Why would they get in while they still can? Again, rates are supposed to go down at the end of this year. Why would they rush in when they know that, when pretty much the entire economy and the entire country right now knows that by the end of this year, rates are going to be lower? They're going to be lower by the end of this year. It's almost a guarantee. Homeowners are still contending with very little supply and very high and rising home prices, except with new homes. New homes, the prices are going down and supply is skyrocketing up. This is talking about existing homes, completely different world than new homes. The question now is, with rates in the 6% range, will they stay there? And if they do, will that be enough to get potential sellers off the fence to get some more supply in the market? The builders are a bright spot, especially because they can buy down mortgage rates, but new homes do come at a price premium. We're actually starting to see some subdivisions have new homes listed under median sales price for existing. It's actually flipping again, because they have too many houses. New home builders depending on your metro, I'm in Texas, so we have a whole bunch of new homes everywhere. But depending on your metro, they can't sell their houses. They're just sitting there. It's crazy. Mortgage rates started this week higher after also edging up on Friday. They are now at the highest level in 2 weeks, but still in the 6% range. It's not necessarily indicative of ongoing momentum toward higher rates. Who added the momentum is most likely to be determined by the incoming economic data from the minutes from the latest Federal Reserve meeting released on Wednesdays and the government's monthly employment report Friday. Now, I wanted to show you guys this real quick. This is the most recent housing market update from Redfin, and here's Redfin Home Buying Demand Index. So again, yeah, interest rates dropped right since October, yet demand is lower. Even again, according to Redfin, demand is lower. And this is not just purchase applications or applications for mortgages. Demand is lower by 6% year over year. So again, demand is down on all data sets that we are reviewing. And I want you guys to do me a favor. Why do you think mortgage applications are down? I mean, everyone has heard it, right? Rates are going to go down. Buyers are going to come shooting back into the market. But I think that depending how much rates go down, right? If it's just these, electoral 25 basis points, eighth of a basis point hit, maybe that's not going to do much. But once the economy really starts falling apart and we have like 100 basis point, 200 basis point rate cut, that is going to cause a flood of sellers, not necessarily buyers, but sellers to come back into the market and potentially flood the market with inventory. But again, I want you guys to think about it. If rates went down, if they dropped, they sunk, right? They plummeted. Why has demand also go down? And before you say seasonality, understand that we were comparing year over year info. And when we compare year over year info, that takes into account seasonality. So again, I ask you, rates plummeted, right? That's what we hear, right? They dropped off a cliff. They've dropped what, 140, 130 basis points? And demand got worse, except for cash out refinances. And imagine how bad that really is. So you're taking a homeowner, again, sitting at 2, 3, 4% interest rate. They're having a hard time, and they have a low mortgage payment. Keep in mind, with that 2 and 3% mortgage rate, they still are struggling. Even though their mortgage payment, probably $1,000, $2,000 lower than what it would be if they repurchased, they still can't afford to live. They're cashing out their home equity and buying Christmas presents. And by doing so, they've just increased their mortgage payment $1,000 a month, potentially. Think about how bad that really is. And let me ask you another thing. Do you think that is sustainable? Do you really think that that is sustainable? I don't think that's sustainable. I think what's happening here, what appears to be sustainable, is the propping up, is the bailing out, the stimulus, the PPP. All of the money that was printed is still not as much, not nearly as much, but there's still a little bit of that in the market left. And I think that that acted as a smokescreen and gave people unrealistic expectations about the housing market. The housing market's propped up. We're in the biggest asset bubble that we've ever been in by any data point. Look at the PE ratio. The bubble right now is bigger than what it was during the great financial crisis. And not for a second do I think this is going to normalize. I think it's confusing. I think people are frustrated. I think it's hard to understand. And I also think most consumers are just going to continue to spend and spend and spend until they get their credit cards taken away. And how does that happen? Bankruptcy, collections, defaults. That's how that happens. But either way, you guys be careful on the narrative. Hopefully I'm giving you a more bearish approach, a more cautious approach on how to move forward in the housing market. Again, I'm really anxious to hear from you. Share with us your insights. And other than that, if you're out there investing in real estate, you know that I wish you luck and I hope you win.